For Wall Street Media, this is Sam, and I'm here with Doug, and we'll help you make money in the stock market with information you can't find anywhere else.
Hey, Sam.
Hi, Doug.
How you doing?
Fine, how are you?
I'm okay. We've got Rich Gordon, so it always makes it a good day. Guys, he's the super wonderful, ethical, smart guy, right? And I never have a nice word about anybody, so you better take that as uber high praise. And he's Wachovia's fixed income market strategist. What's he say this week, Sam?
Rich Gordon, fixed income market strategist for Wachovia Securities, explains how the hunt for acceptable returns proves fruitless so far.
The economic data over the past few weeks presents a pretty clear picture of the U.S. economy. It's in a very slow growth mode, weighed down by a combination of insufficient extensions of credit by private lenders and a weak housing market. The Fed lending survey released on Monday shows that banks are continuing to raise lending standards and reduce their risk. Corporate managers are paring back expenditures and sizing their companies to an economy with a slow growth rate for the rest of 2008 and into 2009. So we can foresee the unemployment rate, which is already up to 5.7%, continuing to edge higher for the next few months. At its meeting last week, the Fed kept the Fed funds rate at 2%. They'll probably stay on hold for the rest of 2008. The Treasury market appears to have settled into a tight range, with the 2-year yield trending sideways over the past 2 weeks. Short-dated interest rate volatility has already dropped sharply during that period. But given our view of the Fed on hold for the rest of this year, look for investors to use coupon clipping strategies to boost their portfolio returns and for short-dated volatility to continue to fall more. The table highlights portfolio managers' predicament in 2008. It shows the year-to-date total returns of key sectors of the broad-based fixed income index. Here are some observations. First, other than tips, nothing has returned more than 2% so far this year, which is very characteristic performance for fixed income sectors in a bear market. Last year, investors that fled the spread sectors found performance enhancement in the Treasury market. That hasn't worked nearly as well this year. The 2-year Treasury yield is more than 30 basis points lower than where it was at the beginning of January, but the 10-year Treasury is right where it began the year, just above 4%. Second, the excellent performance of tips highlights just how challenging this year has been for almost every other fixed income asset class. The predictable outcome of stagflationary pressures in 2008 so far has been negative absolute returns for the corporate credit sectors this year. Both investment grade and particularly high-yield bonds have been under pressure recently, and those sectors remain vulnerable to additional underperformance over the near term. With where we are in the credit cycle, there should be better entry points in the future. The high-yield sector in particular feels very vulnerable. Spreads are still well inside of their historical wides, and the speculative default rate is likely to continue trending higher over the next year or longer. Third, mortgage sector performance has been very disappointing. The total return is barely positive from what's supposed to be a product with good yields and high credit quality. Conventional MBS has suffered due to a combination of credit concerns surrounding the GSEs, balance sheet deleveraging by banks in the U.S., and lack of foreign sponsorship. Conventional spreads have widened out recently to near the level seen in March, just ahead of the Bear Stearns situation. I think that this sector looks attractive right now. The U.S. government has clearly provided a credit backstop for GSE mortgage debt, and the pass-throughs remain liquid and eligible for financing. With the Fed on hold, MBS looks like the fixed income sector with the best risk-adjusted return profile. Treasuries just aren't going to provide the kinds of returns that money managers need for the rest of 2008 to catch up, and the credit-sensitive sectors still feel very vulnerable to further widening. Although it's not in the table, one sector that's held up over the past few months is munis. The chart shows a relative performance comparison between the municipal bond ETF and the investment-grade corporate bond ETF. During February, municipals sharply underperformed corporates as the disintegration in the market for 7-day put paper bond insured downgrades, and TOBS unwinds resulted in huge pricing dislocations in the muni market. But since the middle of June, the sector has slowly recovered. It's outperformed corporates by almost 3 points as crossover accounts and retail buyers have capitalized on the cheap levels. Municipal credits, especially GOs and essential service revenue bonds, have lower historical default rates than corporate bonds of the same rating, so munis have benefited from a renewed emphasis on credit fundamentals. In commodities and currencies, several long-term bull trends have been undergoing corrections over the past few weeks. Oil prices have now retraced 21% from their highs. The chart shows that the 45% annualized trend increase in oil prices since the beginning of 2007 is being tested. Through there, the next good support is near $100 a barrel. Some of this may be due to seasonal factors like the end of the peak driving season in the U.S. But more likely, there was so much hot money that a significant correction was inevitable. To me, it doesn't seem the fundamental situation has really changed. There's more demand than available supply for oil, so until viable alternative sources are developed and come online, I think that any material weakness or sharp corrections in oil should be bought. In currencies, the euro has weakened against the dollar as traders have paired bets that the ECB would initiate a cycle of rate increases in order to control inflationary pressures. The euro has been weak since breaking its 50-day moving average late in July and further extended the loss after breaking through the 200-day moving average last week. The chart of gold looks about the same, with an even greater trade-off after the 200-day moving average was broken last week.
Well, guys, that's Rich Gordon. He's a Wall Street rock star, and we're bringing him to you. All the big institutional and funds and everything listen to him, and we're bringing it to you so you can hear what they're hearing at the same time.
Seems to be a big fan of oil.
Yeah, he thinks that, oil just has like the basic supply and demand function, and he thinks, supply is not growing and demand is growing. And I like him and I respect him. We have him, 30 or 40 times a year, right, German?
Yep.
Yeah, fantastic. Good stuff.
Yeah.
Thanks, Sam.
Anytime. We are here every day at Wall Street Media. You can find us directly at WSMCO.com. Thanks.